Right, my name is Mike Brown and I work with a company called etfSA, Exchange Traded Fund in South Africa. As Mark said, etfSA is a business that enables you now to buy these indices. And you're buying the indices in the form of exchange traded funds or what we call exchange traded products. So let's explain, and I'm going to cover some ground that Mark's done already, but I don't want to cover too much ground. But let's explain again just what an exchange traded product is. It's a share, a security. It's listed in the stock market. And what it does, instead of giving access to just one company, now you all know shares, you can buy shares for ETFs Bank or First National Bank, or you can buy shares, and you probably don't want to do it in African Bank, but whatever have you can buy shares in any company listed in the stock market. That gives you exposure to the financial results and part ownership of that particular company. What an ETF does, it gives you access to a portfolio, so the whole group of companies. So an ETF is a security, but it gives you access to a portfolio or a fund. And that's why exchange traded products are often called exchange traded funds, and I'll run you through that as well. So what an exchange traded fund does, it trades in an exchange and it's a share, but it gives you access to a portfolio. That portfolio tracks an index. And that's what Mark's been talking about. He's been telling us what are indices. So an ETF is the easiest way of getting access to an index. And what an index is, it's a whole bunch of shares that follows a certain theme. So let's just go and revisit an index. This is the top 40 index on the JSE. And the top 40 companies are chosen in terms of their size and how much they trade. And it's alphabetical. So it starts at Anglo-American and goes down through Anglo-Gold, Ashanti, African Rainbow, etc., etc. And just in case you're saying that's not 40 companies, well, there's 40 companies because there's 2 pages. So it goes all the way down to Woolworths. So it starts at A and goes down to W. So when you buy an ETF that gives you access to this basket, so you're buying a top 40 ETF, which would be, say, Satrix 40. When you buy Satrix 40, what you're actually doing is you're buying a portfolio where you own a little bit of each of those 40 shares. So I buy one share, one ETF, and that gives me partial ownership of a portfolio of 40 shares. Now that's a bargain. Huh? That's great. So it's like buying a box of chocolates. There's 40 different chocolates inside, and I own all those chocolates myself. I can eat them all myself. They're not anybody else's chocolates. So what I'm owning is I'm buying that index, and I'm buying it with a single security. And the amount of securities that I own is shown by this, what we call the market cap weighting. And you'll see some companies are bigger than others. Let's take South African breweries, SAB Miller. That's an important company because it makes beer, which I mean is something that's worthwhile. As opposed to, say, Woolworths, which just, sells food and women's underwear and stuff like that. So it's a bigger company than Woolworths. So when you're buying your ETF, 11% of your money, let's say you're investing 100 Rand, 11 Rand and 4 cents of your money is going to be invested in South African breweries, and 1 Rand 18 is going to be invested in Woolworths. But you own all those shares. So you own a portfolio of a lot of companies. What does that do? That diversifies your risk. You're not in one single company, which is risky. You're now in a portfolio of a number of companies, and these are the top companies in the stock market. Rembrandt, massive company. Sanlam, Sasol. I mean, Sasol is one of the biggest chemical companies in the world. You own a part of Sasol, and so on. So that's all an ETF does. It gives you access to those indices that Mark was talking to you about earlier. And I'll talk about the different types of indices that you get access to. So here's an ETF. Nice and simple. I don't know which share to buy. I don't know how to get research to say, should I be in this bank or this company or that company? I just buy an index. And that index is always going to be the best companies in the market because the JSE only selects the companies which are the top in terms of size and liquidity. So that's all my ETF is. Nice and simple, nice simple concept. So the case for an exchange traded product or an exchange traded fund is that you buy one ETF, one ETP, exchange traded product, but you own a whole portfolio of shares. Now that's a bit of a bargain because you're only paying once to buy that security. So if you had to go and buy all 40 of those shares, you'd have to pay stock brokerage charges 40 times and JSE fees 40 times. And STT, which is tax, securities transfer taxes, is value added tax on shares. You'd have to pay all those 40 times. When you buy an ETF, you only pay that once. And you don't pay STT because the ETF's already paid that on, or STT on buying the portfolio, so you don't have to pay that twice. So it's a real bargain that in fact for a low cost you're getting exposure to the stock market, the equity market. And that's what you want to do. I want to be exposed to the equity market. I want to own shares. And an ETF is a very good way to do it. And that's all it is. It's quite a simple concept. But as Mark explained, there's different types of indices, but that's effectively the case for an ETF. Now, I said that ETFs are quite cheap. That's just some numbers in terms of expenses. If you buy an exchange-traded fund on the JSE, the management cost of that fund is about 33 basis points and 0.3% per annum. You can buy unit trust index trackers, but they have double the costs. Or you can buy a general unit trust, and that has about 5 times the cost of an ETF. So they're very cheap. They're low cost because they're quite simple products. They just go and duplicate an index. They don't have to employ lots of people to go and select which companies to buy and do research and do risk management and do all the rest. Just buy the index. And you can buy them through low brokerage schemes, which is what etfSA is. It's a very low brokerage scheme. And as I said, you don't have to pay STT. So what ETFs are is a bargain. But what they are doing, and I'll show you some numbers later, is they're actually giving you access to a good portfolio of shares. So you're buying the best companies in the stock market, but you're buying it very cost effectively. How well do they perform? Well, this is in South Africa, and these figures are as of June this year, June 2014. And what this says is that all the equity unit trusts, and unit trusts I think are quite well known. A unit trust is an actively managed portfolio where the manager of a unit trust will go out and he'll select a portfolio of shares and he'll charge you quite high fees on the basis that he says that this portfolio can outperform the general market index. And all an index is the average performance of a market, because the index measures every 15 seconds on the JSE, the index measures what's the price of all 40 shares in the top 40 index, all 25 shares in the industrial 25 index. So an index gives you the average return of the market.